In this week's update, don't buy this bounce yet, but the next phase will be strong. And gold correction probably not finished. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. Well, last weekend I indicated that a short-term top was probable, and the market rose for another couple of days in the US, and then it all fell apart on Thursday night and Friday night before a bit of a late rally on Friday night. So it was pretty predictable what was happening. It was fairly obvious if you're following the signs, and really the market had moved to such an excess that it really shouldn't have come as any surprise to anybody, really. So the short-term tops, the signs, just to recap, the things that sort of bothered me. The put to call ratio was very low, which meant that people were loading into calls and not taking much in the way of put insurance, and that generally leads to a situation where the market is unstable. We saw the VIX starting to rise at the end of the week before, while stocks were still rising, and that really continued in the couple of days leading up to the very severe pullback on Friday night. On Thursday night. We also saw sector rotation into more defensive type of stocks that had started probably about a week ago. We then got a few more strong days of the tech stocks, but then that rotation really accelerated into the defensives late in the week. And of course, we'd also seen very excessive stock deviation to the upside, and we often see that. So that in itself is not a reason to pull back from the market, but that with all the other things that were going on in the options market and with the VIX index as well, was just enough to kind of all make sense to me. So let's just take a look at a couple of charts so I can make a couple of key points here. So we just look at some of the deviations to the upside. So I'm just picking a couple of stocks at random. So this is Apple, and you can see just how far to the upside Apple had gone. And on the Wednesday, we gapped up massively. Just look at how far the price is above the 20-day moving average, which is this green line, and above the 50-day moving average, which is this blue line. It's really as far extended as it ever gets. And so that was always going to mean revert, irrespective. So we saw a lot of that sort of price action. If you look at Amazon, it was something similar. So the tech stocks had really just run too far, too fast. And then if we look at the VIX index, so this is the VIX index over the last 12 months. And you can see here's the massive spike that we saw in February and March, where the VIX got up above 80. We then have decayed back down, but we were still in the low 20s. And that is still a relatively elevated level compared to the normal, which is somewhere between 12 and let's say 16 or 18. And then you can see we had a bit of a spike up in the VIX in June, in the early part of June. And we'll look at what the consequences of that were for the S&P. And of course now we've just had this spike up in the last couple of days to close out the week at 33.5. This chart shows closing prices, but let's just zero in a little bit. So let's go into 5 days and look at it on an intraday basis. So this is what the last 5 days looks like, and you can see that during Friday we actually spiked up almost to 40 on an intraday basis. So if we go back to the bigger term, you can see that was virtually on an intraday basis the same as what we saw in June. So then if we look at the consequences of that for the S&P, now in June the S&P, so this dropped from here down to here, dropped 7.8%. Now so far from the highs on Wednesday to the lows on Friday, the S&P is down 6.5%. So almost inevitably you get a little bounce. We got a bounce here in June, and then we came back down again and formed almost a very short-term double bottom, and then the market took off again. And we might see something similar this time. I really don't see any reason why it wouldn't be too much different to what we saw in June. So that's why I wouldn't be buying into this bounce, thinking that this turnaround on Friday is pretty much the end of it, because it's likely we'll get a bit of a bounce to a lower high and then we'll go down again. Now, whether we go down to this level or whether we go down lower, remains to be seen. But to be honest, it's not important. It really isn't. And as I've been saying for a long time now, you really want to be looking at the price action of specific stocks and not making your decisions based on what the index is doing, because we're seeing such incredible divergence between individual stocks and the index itself that it's kind of pointless basing your decisions around the index. But for the purpose of what I'm doing, it paints a bit of a picture. So where to from here, I guess, is the key question. So from my perspective, nothing has changed other than in the very short term, where we're getting a reset from just a really excessive period of buying. The bull market in technology stocks will keep powering on. That's almost a given. We've got a paradigm shift happening in how the world works, and I don't think that is registered with most investors. I do very extensive reading constantly, and the overwhelming impression I get is that people really haven't yet started adjusting their thinking to just how much the world is changing and how quickly it's changing. And therefore, if you're still using old yardsticks to measure value in the stocks that you buy, then you're really using the wrong metrics altogether. The new ways of living that we've all had to suddenly and rapidly come to terms with are becoming quite ingrained. And COVID-19 has really just served to accelerate the existing trends that were there, trends that were going to unfold over the next 3 to 5 years have unfolded in the space of 3 months. And if you look at results for companies like Zoom, for instance, they will say the same thing in their commentary, that they were always going to get to this point, but it was going to take them years instead of months. So those trends are accelerating very, very dramatically. And the ramifications of 5G are going to be absolutely staggering. The more you read about what 5G is going to do for the way that we go about living our daily lives, it's quite incredible. And so that obviously has huge ramifications for investing as well. So what industries are set to prosper in this rapidly changing world? Look, there's many areas of technology, artificial intelligence, 5G, the list goes on and on, cloud computing. I think everyone pretty much has a sense of what those areas are, and there's many of them. Another key area, of course, is renewable energy and water treatment are two key themes that are going to have strong tailwinds for a long period of time. Innovative healthcare is pretty obvious, and there's just some amazing work being done at the moment. A lot of it focused on the virus treatment or cure, vaccine, whatever you want to call it, but in many other areas as well. And then, of course, we've got the precious metals complex and other commodities, agricultural commodities as well, are all going to have tailwinds over the next 3 to 5 years. Now, looking at which ones of these are historically cheap, and many of the technologies and the healthcares and those sort of stocks are certainly not historically cheap. In fact, they're quite probably historically expensive. But the one that's really cheap, to my way of thinking at the moment, is precious metals on all sorts of metrics, and I've been covering that now for months. There are some specific stocks in other sectors that are relatively cheap if you're looking for cheap, but cheap is not the main reason why one should buy. That is the way that value investors have always worked, and value investors have been left behind for probably most of the last 5 years. So cheap is not what you should be looking for, because that doesn't guarantee you any success in investing. And in fact, it's been almost a failure in investing in the last 5 years. The reality is that most of the time we've got to pay up for growth, and we've got to pay up for the certainty of that future growth. And that's, just the way that the market is these days. So embrace it. Now, I just want to show a couple of other quick charts, and these aren't recommendations because there are literally hundreds and hundreds of these sorts of stocks that. Sorry, I'll just get up the right chart. There are literally hundreds and hundreds of these sort of stocks in America, and equally many dozens in Australia that have just got such an exciting future with such strong tailwinds. Here's just a couple. This is Carvana, which is basically buying and selling cars online as a completely new way of going about that task. Now, you can see the price had moved very significantly from just under 100, and we got to over 200. Got ahead of itself. We're now getting a pullback, and it could pull back significantly more deeply yet. But my view is that this stock price will be significantly higher in 1 or 2 years' time. So it's really just a matter of determining your entry technique and managing the trade along the way. Zoom is another one. Now, this really did get a bit ridiculous on their results. The price jumped from around 300, and it had already risen threefold from February. But the price then jumped from 300 to almost 500 on their earnings. Earnings were so robust. Now, predictably, we're getting a very, very sharp pullback, and there's probably more to come. We'll probably come back and fill this little gap here. But the point is that the business of Zoom communications is just going along at an extraordinary rate. And that will be reflected in the share price in the future. It's really just a matter of sorting out how you can take advantage of these trends that are occurring. Now, one of the key areas that I want to look at is XLK, but I'll come back to that because that's the overall technology index for the US. So I'll come back to that point. So American stocks, the S&P, for the record, fell 2.3% for the week. But it's still obviously up considerably since the March lows. Now, part of the durations were due to how ETFs work, and I've been talking about this for years. ETFs become a self-reinforcing or self-propelling mechanism to the upside, but when markets turn, they go into reverse. So it works in both directions. And to a degree, markets are going up and markets are going down, not based on logic, not based on fundamentals or value. It's just the dynamics of how the ETF market works. So this period that we're going through now, where we're going to see, or we are seeing a rotation from the growth leaders, technology in all forms, and we're now moving back into some of the defensive kind of areas. Financials did okay. They were about flat last week. Real estate trusts were about flat last week. Utilities were relatively strong. So all the defensives did okay last week. But that's just normal sector rotation, and it will be relatively temporary. At the index level, you can expect a bounce and then further selling, and I think that will be particularly the case in technology stocks. So don't be too anxious to jump back into this market. Tech had reached a silly level, and it had to correct, as we saw from some of those charts a few minutes ago. But it's almost certain that technology will take the leadership back again. We'll see the Amazons and the Googles and Facebook and Netflix and all those stocks will certainly lead the market higher once we get beyond this little period of correction. And the US dollar had a small bounce to 92.82, but as we'll see in the chart, it's still in overall downtrend. And the 10-year yield was pretty much unchanged at 0.72. So let's take a look at some of the index charts. So there's the S&P that I looked at before. So a likely support level here at 33.93. That was punctured on Friday night intraday, but then we managed to get a late rally. There is a holiday in America this Monday. So there'll be no trading until Tuesday and a shortened week. So I would expect a little bit of follow-through buying if things play out as per normal, and then we'll probably go down a little bit more. Now, the various levels that we can look at, the 50-day moving average is probably going to come in around about 33.15, 33.20. We could decline a little bit further down to, say, 32.30, but it really is pretty immaterial. You really should be looking at the individual stocks that you want to trade and base your decisions around them. Now, in terms of signals, I'll be watching the XLK, which is the overall index. I'll be watching that very closely as well. You can see just how much more volatile this index was compared to the S&P. And there really was a very substantial turnaround on Friday. And you can see the volumes down here really shot up very, very strongly. Not as high as we saw in the crash in March, but certainly significantly above anything that we've seen since June. So that's the situation in the US. Now let's look at the currency. So you can see we've had a series of bounces in the US dollar index. If we pan back, you can see that we really don't have support come in until we get a little bit below 90. So there's still a bit of a ways to go yet. But it's pretty clear we're forming lower highs and lower lows and continue to do so. So unless we can take out this level here, then the US dollar remains in downtrend. That's obviously putting upward pressure on the Australian dollar. It's also putting upward pressure on the gold and silver prices as well, and other commodities. And speaking of the Australian dollar, so we've now broken out of that channel that we were trading in, and one would think that it's possible, depending on how the US dollar goes, but it's possible we could even start to revisit somewhere closer to 80. Although I suspect the hit that our economy is taking from the lockdown in Victoria will probably get in the way of that, but it's certainly being helped by the strength in iron ore, which is approaching $130 a tonne, which seemed pretty inconceivable a few months ago. Moving on to the Australian market, our dollar, our dollar was higher, beg your pardon, and it was really quite a volatile week for currencies. The ASX 200, we ended up losing 2.4% on the week, and I would imagine there will be more selling at the index level on Monday. Every sector got hit, and it was pretty obvious by the data that I saw that there is a component of overseas selling in this. So overseas funds are losing money because the Australian dollar's going up. So part of the selling is not because they necessarily wanted to sell those stocks. It's just that it's a global allocation issue, and the movement in the currency has some bearing on that. But look, the net result will be we're now going to see far better entries in stocks that have been very buoyant and hard to get into. So, we need to embrace these periods because they provide opportunities that we otherwise don't get. And the shopping list in Australia is just amazing, as certainly as members of both my membership services, Portfolio Analyst and the Insiders Club, would know, because we've had some tremendous results. And I've got a lot of other stocks that are just really too many to roll out to members. So the shopping list in Australia is of stocks that are highly likely to go higher in the future is just stunning. It's a very, very exciting period. Just a quick look at the ASX 200. So you can see very sharp fall on Friday. I would be very surprised if we don't see some follow-through selling on Monday, because the Australian dollar is still going up, so we're still going to see that pressure from overseas funds. Now, turning to gold and silver. So this is gold on a weekly. So you can see we broke above this this key, which was the previous all-time high from 2011. So we broke above that key level and have been able to sustain it for the last 5 weeks. So it's a very, very strong
period for gold when it got ahead of itself. You can see we got right outside the uptrend channel, starting to form a channel that's going up at an even faster rate. That wasn't really sustainable until we get some sort of consolidation at least. Now, whether it corrects back further into this channel or whether it just goes sideways and lets the moving averages catch up, that remains to be seen. Certainly the environment for precious metals is so conducively strong that, you know, I probably tend to favour the sideways consolidation rather than a further move down. That seems to make more sense to me. But look, it's only about probabilities. These aren't predictions, they're just observations of what is probable. Switching to a daily chart, you can see that the ranges have got fairly small now. Again, this supports the likelihood of consolidation more than a more significant pullback. So we've already come back close to the 50. It's quite possible that we might move sideways a bit more yet, but I'll come back to that chart in a minute. I just want to go back to the slides. Now, silver continues to do better than gold, but that's only because it had an enormous amount of catch-up to do coming out of the March lows, where silver had been sold off far more heavily than gold. So silver is still outperforming. All right, let me just go to the slides and then I'll come back to that chart. So gold was down $31 on the week, finished at $19.34. But look, here's the checklist of why the environment for gold and silver is so good. Real bond yields are falling. So that's in real terms. So that's the nominal bond yield minus the rate of inflation. And real bond yields are something like minus 4%. So this is perfect for gold. The US dollar is falling. Again, perfect for gold. There is money coming out of the bond market that's seeking another home. Now, money originally goes into the bond market because a lot of people want to diversify away from equities. So money that's now coming out of the bond market because the return is just, ridiculously small, would prefer not to go into equities. They prefer to go into something else for diversification. So again, this is perfect for gold. Now, not everyone's going to do this, but it would only take a very, very tiny fraction of bond market money deciding to go into gold for diversification. And the effect on the gold market is massive. Central banks around the world are engaged in deliberate currency debasement. It's been going on for probably most of the last decade. Again, this is perfect for gold. The purchasing power of all currencies is going down. And you may have read or heard of the term the race to the bottom in currencies. And, the only thing that's really holding its value ultimately is gold. And then, of course, in the last week and a half, we've seen a dramatic shift in Fed policy, where they're now basically saying, well, we want to push inflation up above 2% and we're going to hold it there. And we don't care really how high it goes, because all it's doing is compensating for this long period where inflation was too low. So again, this is just a perfect environment for gold. I think you get the picture. This is just a stunning period. Now, that doesn't mean that gold is going to take off tomorrow, because I still think we need to go through a period of rebalancing. But if you look at gold miners, particularly on the global stage, the margins for major US gold miners is around about 100%. Roughly, their costs are around $1,000 an ounce to produce. They're all in sustaining cost. And they're getting nearly $2,000 an ounce for their product. So nearly 100% margins. And when you compare the price of gold stocks to, let's say, technology stocks, it's no wonder that Warren Buffett finally came to his senses and invested in Barrick Mines, because on a relative value basis, there's a heck of a case you can make for owning gold stocks, particularly ones that pay a dividend. So gold stocks have rarely been cheaper relative to gold, and they've rarely been cheaper compared to the S&P. Now, that doesn't mean that we can't get some more downside in the short term, and I think that will still be the case. I'm not expecting gold stocks to take off just yet.
All right, turning to other commodities, copper was steady at $3.03. Crude oil was down sharply, however, lost about 8% down to just under $40. There's the spot copper chart. So wrapping it up, the correction we're in at the moment is normal. It was overdue, and you should embrace it and not be fearful of it, because it's just going to set up great opportunities. The odds don't favour buying this bounce just yet. Now, who knows? Maybe Friday night's turnaround was it, and it just goes straight back up from here. But I would assign that a relatively low probability. The excess was just too great. I don't think it's going to wash out in a session and a half. We need more time when you understand the dynamics of what drives the market and drives the ETF market and the options market. It just needs more time to adjust. But use this period, be it days or weeks, to get your watch list prepared, understand what it is you want to own, get your strategy around entries and management prepared. You don't want to wait and then start doing it when the market is moving quickly. You need to know very clearly in advance what and where you want to buy into these stocks. So don't just go and buy anything, without knowing exactly how you intend to manage it. Now, I've been doing this for a long, long time, and I've worked with thousands and thousands of traders and investors, and I know that the majority of people still do it in that way. They just go and buy something, a name comes onto their radar, and they just buy it without any thought to how they're going to manage it. How would you get out of it if you needed to? How would you take profit if it came to that point? So you need to get all those things sorted out. And this is something that gets a lot of focus in Portfolio Analyst and also in the Insiders Club. Now, Portfolio Analyst this week coming, it's all about positioning for the next phase, which is just really, really exciting. And the strategic setups that I'm going to be looking for. So it should be another good session in Portfolio Analyst.